Hi, everyone. This is Rob Barnett, and I'd like to welcome you to today's final webinar in a three-part series. It's been a pleasure to partner with the team at Cowen. We've discussed everything from batteries to the hydrogen economy, and we're concluding today with an in-depth discussion about what the future of oil majors, or energy majors as many of them want to be called these days, and what the future looks like for them. So we've got the talented analyst Jason Gabelman joining from Cowen. We also have Will Hares joining from Bloomberg Intelligence, and I think this is the right place for a fun discussion about the BPs, Shells, Exxons, Chevrons of this world. So to kick off, we're going to start with just where the oil price is at. Pretty tepid day there in the market. We hit an intraday high of nearly $140 a barrel back in March. Today we're flirting with $95 a barrel for Brent crude. What do you make of the wild oscillations that we're seeing, and do you think it's going to make a big material difference in strategy for the oil majors if we're looking at 140 versus something much closer to 100? So Jason, love to get your thoughts on kind of where we're at in the price cycle.
Yeah, hey Rob, and thanks for putting this together as well as the other two sessions. We appreciate partnering with Bloomberg as well. They do great energy work over there, and thanks everyone for joining. The recent decline in prices seems like a combination of recession fears that are causing a drawdown in, I think, long positions, managed money positions, which is kind of fast money betting on oil, has been cut in half from just a few months ago, and those managed money longs are back down to where they were at the beginning of COVID. So I think part of this is being driven by liquidation of long positions. You add to that the fact that China demand has not come back out of their net zero or their zero COVID lockdowns, and you still have 1 million barrels a day of demand off the market that I think a lot of people expected to come back sooner. And then lastly, Russia production has been pretty resilient despite the war. There was an expectation that production would remain offline, and we saw about 1 million barrels per day come off the market, but it's come back to a certain extent. So I think those are driving, those are the factors driving the near-term volatility. We expect to be higher in oil price later in the year, and I'm happy to get into the drivers of that. But we certainly expect oil prices to rebound, and a lot of what's going on is positioning and near-term dynamics. To answer your other question, no, it doesn't affect oil companies. They don't manage their businesses for $100 oil anymore. They manage it for under $60, and they saw two back-to-back oil cycles, the one after 2015 and the one due to COVID, and that's resulted in them building businesses that are a lot more resilient than they were in the 2010s. So the short answer to that question is no, their strategy is not going to change if oil is $140, $100, or $75.
And so you hinted at expectations for higher prices. I'll note that we just completed a survey amongst our customers, and we asked, what expectations were for Brent prices at the end of 2022. The vast majority see price well over $100 a barrel, but use your crystal ball. Tell us what you're seeing and kind of what's the upside case from where we are today.
Yeah, so I think there are three factors that are going to drop the upside from now to year end. First, there are sanctions on Russia oil that are going to kick in from the EU. Those have been agreed upon already. Those are going to be implemented at the end of the year, and that will likely result in some disruption to oil flows out of Russia. Maybe China and India step in to buy more, but certainly I do not think those countries are going to be able to absorb all of the 4 million barrels a day of oil being exported out of Russia. The second point is the Strategic Petroleum Reserve releases out of the U.S. are going to end. Those are going to end in September. That's 1 million barrels a day of oil that's being added to the market that's going to disappear once we turn the calendar to October 1st. And thirdly, China demand is expected to come back. It's been delayed a bit, but that's 1 million barrels a day, as I mentioned, off the market that we expect to come back. So you add those factors up, and that's a 3 million barrel per day shift from where we are now in terms of oil balances to where we could be at the end of the year. So we think that frames a bullish oil picture into year end.
Okay, Will Hares, I want to bring you on. You take a similar look at the oil market from BI, and I think you're equally bullish on some of the fundamentals in the commodity space, but you want to share your view, and are you similarly aligned in that that there's not a super material difference on strategy at 100 versus something materially higher?
Yeah, thanks, Rob. I think Jason just did a really good overview, and it's certainly pretty aligned with our view. We see this near-term volatility driven by near-term recession fears, blowing out some of the open interest in futures positions, and then just on the supply side, we look increasingly bullish into year-end. We see steep backwardation still in Brent price futures contracts. We're seeing record high crack spreads. This is reflecting still strong refined product demand. We've seen record premiums for Aramco's overseas selling prices recently, declining spare capacity from OPEC, poor growth visibility from non-OPEC, and of course the SPR coming off to the tune of a million barrels a day at the beginning of October, as Jason mentioned. So there's just a lot of tightness here. It's an already tight market, and we just see a lot of blaring red flags for this tightening to continue. And I think I'll just add one more point here before moving on to the oil majors, is that the monetary tightening cannot fix this structural tightness in oil markets. There's been a deep global underinvestment in upstream going back until 2015 now, and we're seeing this in OPEC spare capacity, but also several of the European majors which have already hit peak production or are going to hit peak production in the next handful of years. And so from a strategy standpoint, clearly these companies' strategies are managed on a much longer term basis. They do not respond to this type of volatility in the markets. Where you might see some change in strategy is on the financial framework side. So if they were at $140 realized price, some of that excess free cash flow might be deployed into buybacks. We see some of that, some of these mechanisms being deployed to allow some variability in shareholder returns. And then on the operational side, you do see for those companies with short cycle production exposure, namely the Permian, which European majors do not have much of. BP is essentially the only exception here. This is where it makes sense to try and capture some of this higher price exposure, having this short cycle production that you could bring on in the number of months, rather than long lead time projects, which most of the majors, excluding the Americans, typically pursue.
Very interesting. Okay, thank you, Will. Let's talk a little bit just on downside risk. I mean, the market's been moving pretty substantially lower over the last month, down about 20%. So, what's the bear case? I mean, I know both of you are sort of positively inclined, but Jason, we'll come back to you. Is there a low case scenario driven by a recession or some other factors that we haven't discussed yet?
Yeah, sure. I think there's some cognitive dissonance in thinking that you could have a recession and oil prices remain structurally high And I think that's where the recession risk is. Can you have oil prices remain elevated while there's a recession, or do you need to have demand destruction to bring oil prices down? And that's kind of the short and long of it. I don't have a great answer for that, unfortunately, but that's the question. And in a typical recession, you see about 1% of demand taken off the market. That's only 1 million barrels a day. And based on our balances, that's not going to be enough to bring supply demand back into balance. So that's why we have a more bullish tilt, because even if there is a recession, and using historical sensitivities to recessions with oil demand, it still seems like there will be a supply shortage. But there is a case to be made that demand maybe falls by more during a recession, and that brings oil prices down.
Very interesting. To probe a little bit more on that, what's your sense on how long it's going to take to bring new supply online to get the market in a better fundamental balance? Because I agree with you. I mean, it seems like there's a lot of potential risk on the supply side in the near term. You know, Shell response from the U.S. or other areas. You know, is this years away or perhaps sooner?
It feels like 2024 we could see a more balanced market. You do have areas like Brazil, like Guyana, Norway growing, a few other one-off projects like in Uganda. So there is production coming back or coming online in the future that could bring the market back into balance. And I'm not of the belief, as what Will mentioned, that there's been an underinvestment in supply. I think a lot of it has been geopolitically driven. You have Venezuela with 2 million barrels per day, lower than what they were producing a few years ago. If you just had that alone, the market would probably be in balance now. Iran, obviously, with 1 million barrels per day offline. So it's been a supply shortage that's been generated more from geopolitics, I think, than underinvestment. And I do think as we move forward, if oil prices stay higher for longer, there's going to be pressure to resolve some of those geopolitical situations sooner rather than later.
Okay, so follow-up then. Given we are talking about ESG and the energy transition, do you think that there is investor pressure that's going to limit the supply response from the oil majors, whether it's ESG pressure or actual capital constraints that just simply won't allow them to sort of deliver? Or do you see that as sort of more of a red herring and not something that's actually shaping investment decision right now?
I think there's a desire to generate a lot of free cash flow, and that's what is limiting growth more than anything else. We've seen that in Exxon, changing from the counter-cyclical CapEx spend, and we've seen it how the U.S. shale operators have changed business models. I think that's driving shareholder views more than maybe ESG, which tends to get more credit. The outcome is the same. You see U.S. operators having low single-digit oil production growth, and EU operators managing to flat or even moving lower over the next few years.
Will Harris, I want to bring you on and get your thoughts on this. I know you spent a lot of time looking at CapEx trends for the European oil majors. What's your sense? How much of a role are they going to play in any kind of supply response over the next few years?
It's pretty limited from a European major standpoint. As I mentioned, and as Jason just talked about, most of these companies are nearing peak or have already reached peak production. The only two in the European major group, Equinor and Total, will continue growth probably through mid-decade about. But these trends that we've seen over the last few years, it has been divestment of more carbon intense legacy assets. We've seen BP get rid of their North Slope. We saw Shell sell their Permian. This divestment is obviously not helping the supply on the supply side, but it's also contributing to their part of the intention was to contribute to their sustainability goals, starting to bring down their emissions intensity. But the short answer is there's not much coming from the European majors. They are rationalizing their upstream portfolios, simplifying them, pulling out of new country entry, dialing back some of their higher profile exploration projects, and so the supply side is not being helped from a European major standpoint.
What about the gas side of the equation? Gas is often cited as a sort of key transition fuel. It does feel like the narrative, particularly in Europe, is shifting on that, but maybe that's not the case from the concerns of the Shells, BPs of this world. So how's gas fit in the portfolio, Will?
Yeah, so gas is contrasting with oil. Obviously, it's less carbon intense than oil production, so it's formed an important lever for these companies to gradually adjust and evolve their portfolios, looking towards their net zero 2050 ambitions. And clearly, Russia's invasion of Ukraine has changed the equation on gas in Russia. But this will play out over many years. We need to keep in mind that Europe just can't switch on the renewables. They are accelerating this renewables build out, but right now we are seeing record LNG cargoes being landed in Europe. There is a big mismatch between LNG supply and demand over the next several years, and we're seeing that in regional gas prices. We're seeing it in global LNG prices right now, and so LNG and gas is playing an increasing role within these companies' production weightings. We're seeing the percentage of gas climb to we expect it to be over half, 55% by the end of the decade, which doesn't seem like a big shift from somewhere around low 40% now. But this is it's a very clear change in gradual portfolio evolution for the European majors.
Jason, do you see it the same way? I know you look at some of the European names, but also Exxon and Chevron. Is gas a critical part of the strategy? How important is gas going to be as a sort of profit driver for these companies over the next decade?
Yeah, the European majors are definitely growing their gas footprints, and the U.S. majors are trying to do the same. Shell and Total are two of the top 5 LNG producers in the world, and they want to maintain that market share as the global gas demand grows. And you're seeing, Exxon just took interest in Qatar. It's building out Golden Pass. Chevron's looking to expand their Eastern Mediterranean footprint. So I think all these companies see the dynamics for gas being supportive over the next few years, and they want to lean into that and participate more. The other dynamic, which I think we're seeing evolve in real time because of the invasion in Russia, is if you take gas away, you're not going to reduce emissions. If you take gas away, you're going to substitute that with coal, which has 2 times the emissions as gas does. And I remember when I was in Europe a few years ago speaking to investors, and they would not touch anything that produced gas. And I wonder if that dynamic is going to change for them, because they see what the alternative is. If you try to legislate gas consumption away, what happens? You have emissions go up, not down. So I think the view on gas and the perspectives on it being a good fuel or bad fuel are probably changing as a function of the Russia-Ukraine war.
Will Hares, a pretty interesting signpost on this might be how the Norwegian Sovereign Wealth Fund is approaching investment in the energy space. How have they been positioning around the questions of oil or gas within the mix of the types of companies they want to hold?
Yeah, so an interesting thing that the Norwegian oil fund did. This is the biggest sovereign wealth fund in the world, 1.2 trillion, I think now. A few years ago, they announced that they would divest all of their independent E&Ps, and the rationale or justification that they used was for portfolio diversity, which we think it was not fully honest. It looks a lot more sustainability driven in our view. In any case, they've fully divested all of their pure play independent E&Ps now, of which they held a lot. I think it was $7 billion in investment within this sector. And interestingly enough, they've over that time period, they have increased their share in the top 5 Western oil majors. And so it seems a bit counterintuitive to divest from a portfolio diversity standpoint while you are increasing investment in the Western oil majors. But I think it does make sense from an investor activism sort of point. I mean, these companies are very large, very diverse, and the Norwegian Oil Fund cannot be divesting from the big Western oil majors. They're too critical to the portfolio balance, whereas the independent E&Ps were small enough and I think less important from more of a sustainability risk, I think, moving forward, given the constraints that sector has on reducing emissions as compared to the oil majors.
Jason, I can't help but agreeing with the point that you made on coal just a few minutes ago. Our view is that in Germany, we see coal rewinding back up to roughly the 2018 level over the next 12, 24 months to help offset some of the gas that had been being used in the power sector. This may be one of the reasons we're seeing carbon prices hold up pretty well in the current environment, despite some pullback in some of the other energy commodities. Now, I want to probe, though, a little bit more on kind of the longer term stuff that could be coming in more the kind of decade time scale. So coal, very carbon intensive. We are seeing Germany and some other countries kind of bring back some reliance on that here in the near term. But what about a fuel like hydrogen? When I look at the news feed these days, hydrogen is just, it's all over the place. We saw BP make a big announcement on a hydrogen project in Australia recently. But, what's your sense? How is hydrogen going to play in the next 10 years for the oil majors? And is this something that's real, or is it just hype right now?
I don't want to call it necessarily hype, but certainly the expectations of growth are further out than relative to, I think, the amount of attention that it gets. And the oil majors think this will be a bigger part of their business in the 2030s. In the 2020s, they're trying to figure out how to drive down costs and make it economic and establish these footprints that'll enable cheaper expansions down the road. Hydrogen's still $8 a kilogram, which is, $54 an MCF, which doesn't sound very expensive in the current environment we're in, but in most environments, you're talking 5 times higher than what gas is. So it's still very expensive and not really an economic solution as part of the energy mix. But these companies are making the initial investments, and if you think about it, it's logical that they're the companies doing it. They have a lot of experience managing hydrogen, being able to handle it and use it within processes, particularly in their refining footprint. So they're well positioned to make investments first in blue hydrogen because they're already processing that within their refineries, and ultimately that'll likely lead to investments in green.
Do you think that there is a synergy on the hydrogen equation with investment in traditional renewables, so wind and solar? And I do think there is a sort of interesting transatlantic divide here where we're seeing BP, Shell, TotalEnergies. They're all really ramping up their renewable portfolios. Don't see as much of that in the U.S., but what do you make of that divide, and do you think hydrogen's a piece of that story eventually?
Yeah, that point, that's the key differentiator between U.S. companies' energy transition plans and the EU. It's that investment in renewable power, and EU companies are spending about 20% of annual capex on energy transition, U.S. about 10%. And the difference is mainly investing in renewable power generation. A large driver of that is the fact that EU companies have large trading businesses where the U.S. don't. And EU companies are making the bet that if we build out this integrated footprint, we'll be able to leverage our trading business to generate higher returns from that integrated footprint than we otherwise would. That's part of the reason they think they could earn double the returns that a normal utility does. Instead of doing 5% on a project, they think they could do 10%. Now, that's something that will be proven out over time if that is a good bet or not. I will say a couple of the other ways that they're looking to strengthen returns are farm downs and advantage financing, and both of those are probably seeing more headwinds than tailwinds in the current environment that we're in. So maybe that 10% moves lower over time. But that's certainly the main difference between how these guys approach the energy transition. And as I said, a large part of that is the fact that Europeans have large energy trading businesses.
Will Hares, I want to get you to weigh in on this as well. What's your sense on the sort of target return level that some of these companies might see from the renewable investing they're doing, and what's your sense on the trajectory of where the share of capex goes over the next 5 years for the ones here in Europe?
Yeah, so clearly it shouldn't be surprising to any of the listeners that these renewable projects are significantly lower return than conventional oil projects. We estimate around 8 to 10% return for newest generation offshore wind. This compares to the hurdle rate that you see for approval for new generation oil project of 20 to 25 IRR. So that is clearly a key risk for the European majors, moving pretty significantly into these businesses. As far as share of capex, we see at the same level as Jason does this year, somewhere around 20%, maybe slightly below that. But keep in mind, this has risen significantly over the last several years. It was near zero roughly 5 years ago. Or at least unreported. It was so insignificant from these companies, and it's moved to a fifth for the Europeans. We expect the share of capex moving into green or energy transition businesses to reach at least half by the end of the decade. And I think an important point here is that I think conversely, the reaction from Russia's invasion of Ukraine and this big surge in volatility in oil prices brought some to think that these companies would adjust their capital allocation into oil. And we just talked about this at the top of the hour, but conversely, we think that it's almost certainly going to accelerate their energy transition plans. Part of that, this free cash generation, this monster free cash that we're seeing right now, is going to be and is being deployed into an acceleration of this strategy. We think at least half of capex by 2030 will be green, and we've actually already seen an announcement from Equinor. They already expect half of capex to be green by 2030. So it's growing quickly.
Jason, I want to probe on that for you. What's your sense on uses of cash? I think Will's made the case. He sees more cash being diverted into clean energy projects if you look out over the next 5 to 10 years here in Europe. Do you kind of see it in a similar way, or is there more pressure to do capital returns, or what's the vibe, particularly as if you see any distinction between kind of the U.S. and European side on this?
Yeah, I think it's a balance between returning capital and investing in new businesses. For the European players, there's more focus on returning capital because they have a riskier strategic proposition right now than the U.S. players, which are not pivoting as hard. And the EU players have defined cash returns based on a percentage of cash flow. So, shareholders are able to participate in higher oil prices, and they're not using that capital. They, as was said, they are a bit, but they're not fully using that excess cash to pour it into energy transition investments only. So it's definitely a balance for these players between investing capital in energy transition and returning to shareholders. The other point that I think is important to make is, these projections, 50% capex in energy transition in 2030, I think it's largely dependent on how quickly the world evolves, what customers are willing to spend on energy, and government support. So these companies are not going to make investments if they don't meet the return hurdles. They just won't do it. And so there's this expectation that energy companies are going to transition the world alone, and these 5 oil companies are going to solve the energy transition problems for the world, which is obviously an absurd expectation to have. They only produce 10% of oil production and less of total energy in the world. It's a global problem that requires global solutions and support from a variety of different stakeholders, not just one supply source in isolation. So yes, these companies plan on ratcheting up energy transition spend, but it's highly dependent on how the world evolves. And Shell actually in a recent release had a footnote saying, this is our plan contingent upon the world developing this way. And that was a new footnote for them. So it's not these companies going alone on this.
What's your sense on that policy evolution? I think there's been lots of discussion over the years on carbon taxes or targeted incentives for different technologies. How do you see that policy landscape unfolding? And, I think Exxon for sure has been on the record about advocating a carbon price as a sort of, the best means for tackling a problem like this. But it doesn't feel like we're anywhere close to that from my book. But what's your read?
Yeah, no, I would agree with that. Carbon price seems like the most transparent way to incentivize the reduction in carbon emissions. It doesn't seem like that's politically a workable solution in the U.S., and you'd probably need to see some sort of global agreement on that, which doesn't seem likely. And then you have the government picking winners and losers, which is never a good situation to be in, but it's the one we find ourselves in right now, and you're kind of having to guess what the next winner the government's going to pick. The U.S. government, for its part, seems to be supportive of EVs and hydrogen growing as part of the energy mix. So you'll see companies invest more in that. But it doesn't feel like the U.S. has a cohesive energy transition policy that will enable smart investments that companies and investors alike will have confidence in returns from.
Well, speaking of picking winners and losers, the policy of yesteryear from the U.S., arguably for the oil space, would have been the RFS, so the biofuel mandate. What's your sense on the role that biofuels maybe play in this long future? For some time, there was so much investment and discussion around biofuels, but now it does seem to have transitioned a lot to EVs and hydrogen. Is biofuel still an investable part of the energy space in your view?
Yeah, and we cover some of the biofuels names, so we follow the space pretty closely. It does seem like from a federal government standpoint, they are pushing to remove internal combustion engines rather than replace the fuel used in the engines. So from a federal level, biofuels don't appear as a winner, but you do have state level incentives, particularly the low carbon fuel standard credit program in California, and Canada will implement a similar program next year, which is supportive of biofuels. So we do see support at a state level, and longer term, biofuels probably are most likely to be used as a replacement fuel for jet. There's not a low carbon alternative that could be easily used for jet fuel. Hydrogen and electric both don't work in the air right now over long distances. So biofuels seem to be like a natural solution for jet fuel, and jet fuel's 7 to 8% of the global oil market. So yeah, we think there'll be a role for biofuels in the energy markets moving forward.
Yeah, it tickles me to no end to hear some of the discussion about hydrogen-powered aircraft or even electric, and not to be super skeptical. I'm open to it, and I know Airbus and some of the companies over here are actively investigating it. But it seems like something that's quite long dated, and there is quite a lot of progress, it seems, being made on the biojet piece, even though it's still pretty nascent. And Will, I believe Total Energies and some of the others are sort of being pretty active there. What's your sense on the biojet piece over here in Europe?
Well, I think for the European majors, biofuels forms a smaller component of energy transition strategies as compared to the U.S., which I think is targeting more adjacent energy transition businesses towards their existing oil and gas production. But yeah, for Total and Shell, sustainable aviation fuels and BP, of course, is definitely a component of these strategies. But I think it just pales in comparison to some of the scale of investments that we're seeing on the renewable power side, on the EV charging network side, and even some battery recent battery M&A that we've seen.
Jason, I think you look after Neste, which has also been pretty active name in the biofuel space. What do you make of that for a company like them? Is this a good position to be in the market right now, or is the biofuel story, sort of a next decade thing? Is this something we're really going to see take off in the next 5 years?
So they're producing renewable diesel from their plants right now, and what they'll do is invest in having the capability in those plants to producing biojet. So it will enable flexibility within their plants to do one or the other, depending on how the market evolves. There's a concern that you look out 10 years and there's alternative vehicles on the road for heavy duty vehicles. So diesel will not have the demand it has right now. So having the capability to produce biojet is a good alternative to that, and that's kind of part of Neste's bet. They're also making investments in plastic recycling as well, taking plastic, changing it into a liquid, and producing plastic from that, which is another growing business.
Well, that's an interesting area we haven't touched on yet. I think if you look at Exxon or Shell, BP, any of their long-term scenarios, a big piece of the sort of growth business is petrochemicals, and I'm curious, especially if the transportation piece is perhaps getting a bit more wobbly because of EVs, this kind of thing. What's the role for the sort of demand growth in the future, and is there a threat from what you were just talking about, using biomaterials to substitute in for some of the hydrocarbon molecules? To Jason, sort of long-term risk on sort of bio alternatives.
Yeah, so chemicals grow at a GDP plus rate per year, so you would need to solve for that in addition to the underlying demand growth, and so I think petrochemical demand continuing to grow will help maybe offset some of the fact that demand will be cannibalized from recycled product. So it'll be balanced out, and maybe then oil demand growth isn't exactly as strong as it otherwise would have been, but there will still be demand growth there. And it gets to another point where, these investments are more as much opportunities for these companies as they are threats. Does it impact end demand for their product? Yes. But can they take the capital they're earning, put it into something else that's higher return over time? Perhaps they can do that. And, that's another, I think, misnomer in how these companies are positioned in the energy transition that we're going through. It feels like investors view it only as a threat, but as we've discussed for a large part of this morning, there are opportunities as well.
Will Hares, I want to probe with you on this. One of the things that we ask as part of our regular ongoing survey of energy investors is a question about when they think oil demand could peak. And so, what's your sense on that question? Is it even worth asking? And what do you think? Is there a peak in demand on the horizon at this point?
I think it is a bit of a fool's game to try and, pick the peak, but I think what is interesting is taking a look at the trend of how forecasts and expectations have changed in the last several years. I mean, we've looked at most of the oil companies and OPEC calling for, 2045, 2050 peak, and that has, maybe with OPEC as the exception, that has slowly crawled back to, somewhere around 2030, early 2030s, mid 2030s maybe. Perhaps Russia's invasion of Ukraine has changed the equation on this, as far as the pace of adoption of electric vehicles, maybe trying to dislocate the energy economies from Russia. So arguably you could see an acceleration of that, but from our survey that we pick, it's sort of coalescing in the mid 2030s range. I'm of the view it could be slightly earlier, but once again, this will be the big X factor here is policy of how quickly we accelerate this transition to from fossil based to power.
Yeah, very interesting, Will. I am quite intrigued by this topic, and I do note the very interesting evolution on kind of where people's minds are at on the idea of peak demand. I would note that Darren Wood, CEO of ExxonMobil, gave an interview last month, and I don't think this is Exxon's core case, but he did mention the idea that there is a scenario out there where EVs constitute 100% of new car sales, I think, by 2040. What's your read on that, Will? When EV sales are really on a tremendous growth path, it appears. Do you see 2040 as being reasonable for when we hit that sort of that kind of threshold, or is it sooner or later?
So 100% of new car sales is EVs by 2040 is mostly seen as a pretty aggressive case. That is certainly faster than ours and BNEF's, which has about 50%. Early 2030s is about 50% of global new car sales as EVs. So 100% by 2040 globally would be very quick. And so I think it's surprising that Darren Woods talked about this, given it's sort of at loggerheads with the company's strategy, and also it contrasts sharply with Exxon's own energy outlook from just a couple of years ago, where they said below 30% of new car sales would be EVs by 2040. That was their 2019 energy outlook, and obviously it seems like a strange milestone to bring up, given the lack of Exxon's clean power ambitions. So it seems to be highlighting a potential risk for long-term strategy for the company, given that they are probably the most all in on oil of any of the Western majors, doubling down on Permian and Guyana. But yeah, it's an aggressive. I'm not sure the context of the comments and whether there was a rapid case, but we view 100% of new car sales as EVs by 2040 as pretty ambitious.
Yeah, thoughts from you, Jason? Do you have any kind of timeline for kind of how EVs trickle into the equation? And I'm curious because I think it's not well understood outside of energy circles, but even if we get a big rise in EVs, does it have a near-term impact on oil demand? So how quickly are EVs going to grow in your view, and what's the feedback into the demand side of the equation for oil?
Yeah, and it's important to distinguish between sales and fleet. So it takes 12 years to turn over the passenger vehicle fleet globally. So you need 12 years of 100% EV sales to have a fully 100% EV fleet. So I think that's important just in terms of Darren Wood's comments and putting that into context. You know, I think miles traveled, I was looking at BNET data before this call, 2% of all miles traveled globally in 2021 were electric miles traveled. So it's still very low, and there's a big ramp up that may potentially face some headwinds given the rapid rise in battery prices, given global inflation, and likely the buyers who have been buying EVs to a large extent are the ones who are probably less price sensitive to the next level of buyers out there. You also have EV rebates in the U.S. rolling off. So there's a lot of factors, I think, that could potentially slow down the adoption of EVs. Not to say that they won't continue to grow, but maybe the growth rate slows from what we've seen in the past couple of years. I don't have a number of where that adoption will be and how that impacts demand, but you have to remember you're also contending with overall global demand growth in car sales. So part of the 100% scenario is over time taking a larger share of a growing market. The other point I just want to make, talking about demand plateauing at some time, is it's important to distinguish that demand plateauing doesn't necessarily mean growth capital in oil plateaus. Because for generalist investors who may not realize this, energy has a natural depletion curve of about 3% to 5% per year. So if demand is actually flat, it's essentially the equivalent of another industry growing by 3% to 5% per year. So when you think about oil majors continuing to invest in oil and gas production, which gas also has a depletion rate, it's important to keep that fact in mind, that a lot of this growth investment is actually to keep their oil production flat, not to grow it.
I love that point, and it's one that so often gets overlooked, but you really have to have a pretty precipitous decline, or else you're still going to need new investment in upstream activity to balance the market. So one of the things we haven't touched on here yet is the idea of corporate goals on emissions, right? So we spent a lot of time talking about sort of strategy and maybe where the consumers are at and kind of how all these things feed into the supply-demand balance. But a number of these companies have made goals to reduce emissions. Now, some of them include so-called Scope 3, that's the end-user emissions. But what do you make of those goals that are out there, Jason? Are they achievable? And is this the right emphasis for some of these companies?
So I think there's been a lot of public pressure on these companies to put out 2050 net zero goals, and it went as far as the Netherlands court mandating that Shell not only have this, but accelerate what they said. I think these companies, they have 2030 goals too, especially the Europeans have Scope 1 to 3 emission 2030 goals, and I think they have a good sense of how to get there. Beyond that point, I don't think their plans are as firm, and I think it's once again highly dependent on how the world evolves. You can't expect these companies to be the only ones to decarbonize over time. They have a view on how the world will decarbonize moving forward, and they want to participate in that in an equitable way, not a way that disproportionately negatively impacts them. And I think that's what they're trying to solve for. So they take their best guess beyond 2030, and right now it's about, I think, having different options to participate in different energy transition businesses. So if one of those businesses accelerate and they're able to push the pedal down to further reduce emissions beyond 2030, I think they'll try to do that. But I think it's a good aspiration to have. I think it's foolish to think that, they have exactly scientifically figured it out between 2030 and 2050. They have a sense of, well, we could do this or we could do that, and that'll probably get us close to it, but we're not going to do it alone. We need customers to come along. We need people to come along.
Will Hares, I want to get your point of view. What do you make of the net zero ambitions from some of the oil majors? I would note that you've worked closely with some of our colleagues on the ESG side of the business to create ESG primers for the European oil majors. Do you think that investors who might be looking at investing in an oil company or an oil major really care about having a net zero 2050 target?
Well, I think that a big driver, as Jason alluded to, is different pressures here, mainly from institutional holders, and there's a big divergence between the U.S. and Europe. This is why we see 2050 net zero emissions ambitions, as they call them, not targets, I think, very delicately. But yeah, this has definitely been a response to investor pressure that has been building for years. We continue to see more climate resolutions at AGMs and garnering higher support from shareholders each year. We've seen engine number one, force 3 directors of theirs onto Exxon's board. This has sustainability and ESG overtones to it. It was on a basis of that Exxon strategy was not sustainable enough. Now, I think given the current geopolitical environment, ESG has obviously been pushed to the back burner. Is it going away? No. We can still see all the headline. We're in a heat wave right now in Europe. We're supposed to hit record temperatures here in England over the weekend, and so I don't think this is going away longer term. And I agree with Jason. I think some of these targets are good. Scope 1, Scope 2, they have visibility on how to bring these down. We are starting to see progress as well. Where if you look at the emissions intensity of these companies, they are beginning to track down. Don't get me wrong, there is a long ways to go. And for the Scope 3 emissions, there's a lot of uncertainty, and I think you can see that in the chunk of emissions that they aim to get to net zero, a big part of which they think they'll achieve with carbon offsets, which is sketchy to say the least, I think, at this point.
Jason, I want to come back
point on that topic, because Will mentioned voting, and we actually looked at the ESG proposals in the AGMs and how they did, and they actually went down. So outside proposals on reducing emissions went down 10% year over year. They were at 32%. It's the first year they've declined in 4 years. So certainly it feels like those are garnering less support. We also noticed that companies' non-binding votes on their own energy transition plans, those votes were also down year over year. So we think we're in an environment where investors are maybe starting to realize pushing fully to reduce emissions as quickly as possible is not necessarily the best strategy out there. And maybe these investors don't know everything there is about emissions reductions plans.
Very interesting. One more comment or thought on ESG is just how do we even define it, right? There have been some very notable examples lately where it's been pointed out that a number of these really big ESG funds might hold an ExxonMobil or some of the other oil majors, but at the same time have excluded Tesla for some reason. So when you think about ESG, Jason, does it make sense that an oil major can be an ESG investment?
Sure. I think if you have a plan to improve the business and reduce emissions over time, and maybe you're even reducing emissions while the world's emissions are moving higher, which is something where we saw from 2020 to 2021 and something that we'll likely see again. If you're part of the solution more than the problem and you're on the path to improvement, I think a lot of ESG investors are starting to think about it as what's the path, not are you just good or bad. So, and not all investors are like that. Some of them have an exclusionary bias where they won't invest in oil companies, but there's different, just like there are different investment styles out there, there's different ESG investment styles out there.
So I think let's end on this idea that a lot of investors have a very long time horizon. People making investments that are slowly dripping towards some long duration retirement scheme or something like that. And what's your sense if you look out to 2050? Are these companies that we've been talking about, principally the oil majors and a few others, but are as a group, are they going to make these transition so that they're still viable businesses out in 2050? Or are you worried that, there's a Kodak moment here when you look forward? So we'll come first to you and then we'll go to Jason.
Yeah, so I think sort of to the question, what does an oil or an energy major look like in 2050? Obviously, it's tricky to answer, but the indications that we've seen and some of the comments from management essentially are it's going to be for instance, management has said they plan to produce no oil, effectively zero oil. The majority of their production will be gas, and a chunk of it will be green power. So I think obviously this will vary, but if you're looking at strategies now in the early 2020s, and these companies are already peaking their oil production and increasing gas, investing in significant LNG capacity, keep in mind that the gas remains one of the key levers to decarbonize the world, right? From coal to gas switching in power generation is the easiest and most effective. I personally think that gas has a lot of running room in the years ahead, and I think most of these companies are starting to show that already. Just they're very big companies, and the portfolio evolution will occur over decade plus. So higher proportion of gas, declining oil, and I think by 2050, probably marginal oil production from these companies, majority gas, and the rest green power.
Thoughts from you, Jason?
Yeah, I generally believe with world outlook, I think you have to start from what you think the energy mix will be in 2050. Oil will probably not make up a huge part of it based off most outlooks, and OPEC producers will likely be the last producer standing on that front. So by 2050, you can imagine the super majors, the publicly traded super majors, are producing a lot less oil, very minimal oil. They're producing a lot of gas, and they're participating in new businesses, maybe ones that we don't really fully can see them participating in now. Certainly things like biofuels, carbon capture, hydrogen, renewable power. These are all businesses these companies are investing in, but there'll probably be new businesses that emerge over the next 10 years that are important to the energy transition that these companies will be able to participate in it and hopefully excel in.
Sounds great. Can't wait to see what 2050 looks like. Hopefully we'll all be around to realize it. But I want to thank you for your time today, Jason and Will. This is the final part of a three-part series that we've done with the team at Cowen. All of the discussions have been really great. Jason is a green dot on the terminal right now, so you can shoot him an IB if you've got any follow-up questions. You're also welcome to reach out to Will and I if you want to know anything more about Bloomberg Intelligence. And I hope everyone has a great rest of their week. And we'll have the replay out soon if you want to share this conversation with your network. Take care, everyone.